All right, today is the day that Brandon usually does the market outlook video, but he's a little under the weather today, so I told him I'd step in and do it for him, especially considering that today's my last day of the week. I'll be out the rest of the week, heading to the Northeast there for our fall break with my family. So I won't be back till next Wednesday. That's the next time I do the market outlook is next Wednesday. So I thought, hey, he's out. He's not feeling very well. I can step in and they'll give me a chance to do it one more time before I miss tomorrow, and I won't be here Friday, and I won't be here next Monday either. So that you won't see any videos during those 3 days. It's not that I'm not doing them anymore. I just won't be back again to do this until next Wednesday. Hopefully the market stays okay between now and then. We don't get any craziness. So I'm going to kind of give you an idea of what I expect will happen between now and then in today's video, and why, and what the patterns are suggesting, technical patterns are suggesting, and have they changed any of my expectations. For those who are bullish and looking for a breakout, our trade idea has got a really good breakout pattern developing on a stock in a kind of discretionary technology type space. So we'll talk about how to trade a stock that's really been beaten up, but is showing some really good signals that, man, I would love to see on the market itself. But this stock is getting them. We'll talk about how to trade it and the setup we have for it. So let's go ahead and get started. Today is Tuesday, October the 17th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it really helps us get our content out to all of our followers on those platforms. That's why we always ask for it. So thank you to those who click on this day in and day out. We really appreciate that. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see again, we basically had the same day today as we had yesterday. A little bit longer of an upper shadow, and of course we started from a lot higher close than what we started the day before. So that's why the candle's red instead of the candle being not red, but barely red. I mean, we were down 0.4%, 0.43%. It's not very much at all. It's about as flat as a pancake as you can get here. As you can see, the intermediate line, of course, is still rising. Hence the light green shading. There's two things that make up that bear tag. One of them being the light green shading, the other being this yellow line. So what makes the light green shading? Well, it's the intermediate line rising, being above 20, being out of the reversal zone, but not quite above 50 yet. So it's still in the lower half of the chart, so that makes the light green shading. The yellow line is that we're above the 30-day moving average. In this case, yesterday we were 0.06% above it. Today we're 0.14% above it. So, we're not, you get these bear tags, you want to be able to build on that, as you'll see with our trade idea today later in the video, and really get going. And like we've seen, when it doesn't really get going to the upside, when we can't get, above that 2.5% mark, above the 30-day moving average relatively quickly, then it falters, it fails, and that's kind of what we see. Now you can see when it gets above it quickly, then it doesn't fail. It turns into a new intermediate rally. Same thing over here. It gets above that 2.5% or it gets to it, pretty quickly, and it doesn't fail. And same thing over here. It gets above that 2.5% mark pretty quickly, and it doesn't fail. But when it can't, it tends to fail. And as of right now, it's not looking very good. It's looking like it's more likely to fail than not. Here, of course, nothing's 100% in technical analysis, but that's the idea behind what we're seeing. You almost see the exact same pattern on the Dow Jones Industrial Average. You got a bear tag today. We weren't above the moving average yesterday. We are today, and you notice here on both of the S&P and the Dow, the intermediate line is above market sentiment, and the near-term line is above the intermediate line. But in both cases so far, the near-term line has failed to get into the reversal zone. This would be a pretty bearish near-term peak if that ends up being the case. The momentum line did get into the overbought territory yesterday for the Dow or S&P. It did not get there for the Dow. So it's so again, another sign that it's more likely to fail. The Dow really failed last time. I mean, literally the very next day. It's more likely to fail than not here. You can see the Russell 2000 never did get to, it got the light green shading. The intermediate line rose above 20 barely. But then, of course, it dropped right back below 20. We're back to dark pink shading. And we never did get the yellow line because we never did cross above. So hence no bear tag. Like we got here, we didn't get a bear tag here. And you notice, again, we did get a cluster. And the short-term sentiment's a lot weaker for the Russell 2000. A lot weaker than the rest of the indexes, as we are easily, I mean, we're still more than 1% below the 30-day moving average, though we are making our way back up to it, and we're converging on it. So either converging for a new intermediate run or converging for kind of a sideways move like we saw after the banking crisis, when we kind of settled sideways here for a while. You look at the NASDAQ, this has been the most bullish of the indexes. You can see it's got dark, we got the bear tag over here, light green shading and yellow line. You have to be above the moving average too. But now we have dark green shading, which means the intermediate line's rising above the 50th percentile. You're still a yellow line because we're above a falling moving average still. We haven't broken, we did break back below it once there a couple days ago, and now we're back above it the last 2 days. Even though we were down today, we're still above the moving average. In this case, the near-term line, what's different here is the intermediate line is above market sentiment. The near-term line is not above the intermediate line. So not nearly as bullish on the near-term basis, even if the intermediate line's more bullish. So you can see that how things are kind of shaking out here. This last couple of days has been pretty good for the breadth of the market, not so good for the NASDAQ, which is, I mean, this index essentially, as it says, it's 100 in stocks, but it's essentially 7. It's half the index is 7 companies, the other half is 93. So it really is a reflection of what's going on with the Magnificent 7 more than anything right now. And of course, the Russell 2000 is not, and it's been more bullish in the short term, in the very short term, like with the near term line. Even if it's been less bullish with its intermediate line, that for the member of the Russell is still in the reversal zone. Whereas the NASDAQ's intermediate line, like I said, is the most bullish because we've been rallying, until the last couple of days. It's been doing really well. As you notice here, the ratio chart, I mean, it went parabolic up to in the last 3 days has been the weakest for this ratio. But before that, it had it had been bullish, getting new highs day after day after day until it went parabolic here, last Thursday. And then we've been weak ever since. So you see that reflected in a stronger intermediate line, though now a weaker near-term line because of the past 3 days underperformance. Let's take a look at the weekly chart here. As you can see, again, we're getting a good bullish candle on the S&P. We got a green arrow. Again, the week's not over. We still got 3 days left. So this has got to be the way. It's got to be this. But if today were Friday, that would be a good reversal. Not the greatest. I mean, so we saw that over here. It's not the biggest bullish. We'd like to get a much bigger bullish candle, as you can see, to really get us going. This is obviously not bullish enough, but it's better than being negative, right? There is, and the green arrow is better than not having it. So that's a positive development. Remember, the Russell 2000 is nowhere near. The Russell 2000 is in death cross environment, and as of right now, it would be at best forming a transition candle, a higher low, higher close, upper and lower shadows. So again, we've seen that before. To not turn over, especially if the weekly candle is not a very good bullish candle. So far, so good. We'll see how that turns out by the end of the week. Looking at the 3 green arrow chart, of course, we have 3 green arrows now across the board except for the Russell. We got 3 green arrows here. We've had 2 days of 3 green arrows on the S&P, and then 3 green arrows for 5 of the past 6 days on the NASDAQ. So looking good. No green lines yet, unfortunately, so the moving average is still falling. We kind of need to be bullish. We need to act on these 3 green arrows enough to get the moving average to rise, like it did over here briefly for the NASDAQ, because even that didn't do it. But you need that to turn things around. And obviously we're nowhere near that. And the Dow, of course, just barely got the 3 green arrows today for the first time. Looking at the 2-line versions of the S&P, you can see, again, we hit the 200-day moving average. We jumped up to the 30, 50-day moving average. And like I said, with that bear tag, it looks like we're about to fail. And we've seen this pattern play out before for the Russell. We got to the 200-day moving average. We bounced up. We failed. And then we broke below it. You can go back to SPY, go back to when this whole thing started, when we got over here, we got down to the 200-day moving average. Actually got a little bit below it, got up and failed, and then made a run below. It even got up above it here in March, famously when Jim Cramer called the end of the bear market, very famously, almost pinpointed that top there, and then of course we faltered. So we've seen these kind of moves, getting to the 200, that's what a pullback is, and then getting up and failing on the bounce, and then breaking the 200, which is what a correction is. If you look at the weekly version of this, of course, we are above, as of right now, the 17 and the 8-day exponential moving averages. The MACD appears to be kind of trying to bottom out here below the moving average without having turned strongly negative yet. Let's see how this plays out and see if we can get back above that 23% retracement and turn this ship around. I don't expect that will be the case, but I think that's what we all would like to see, right? For the market to turn back around and get going to the upside. The positive indicator for the DMI is still strongly negative, so this is not a good sign. The negative indicator is dropping, but it's not below 20 yet. So again, another sign that we're likely to fail at that bear tag there. The RSI and the CCI, you can see kind of in sucker zone. We're above 50, but we haven't confirmed it with the move above 60 yet. We're above 0, but we're not really breaking above that strongly above the 150-200 level yet. And of course, the weekly CCI is still below 0. So we haven't broken through that yet, and it's even worse for the Russell 2000, as you can see. So, I mean, as bullish as we've been the last couple of days, you'd think we should be really turning things around, and we just haven't. The trend strength, the bearish trend's gone, but we don't have any inkling of a bullish trend at all. The Qs would be the strongest, and it's still below its cloud, and even though it's above these lines, but below the cloud, and still no trend going. And IWM still has a mature bearish trend going, despite its outperformance over the past few days. So nothing really there yet either. The Bollinger Bands, you can see we are still around the midpoint. We haven't broken into the upper half or upper quartile yet, much less above the 100th percentile, which would be ideal with the bandwidth as low as it is, and with the bandwidth being back inside the Keltner channels. So we're not getting that bullish pattern for reversal yet. And like I said, unlikely that we will. What's interesting here is the breakout today. So this, you can see the high point here is going to move over. And so this is actually day 21. These are the last 20 days here. The reason why we have this is the blue lines aren't used for, the disk day is not used to put up the blue lines. It's the other 20. But on the Arun indicator, it's using these 20 days from right here to over here. So this high tag is going to move over, and you're going to get a jump on that green line tomorrow to 90. Let's see, it's 100 and then 94.73. So you're going to move up to right here, 94.73 tomorrow. Unless we get a new high even higher than that tomorrow, then it will move up to 100. And that's that bullish breakout I've been telling you we've been expecting, with the red line dropping below 70, the green already hitting 0. So if we can jump up above and really get going here tomorrow, then we have some really good potential for a new bullish trend. Otherwise, like we said before, when we failed over here, we got that one touch. If this is the high, if we end up breaking back down tomorrow and finishing to fill in this gap and then some, which is kind of what I expect will happen over the course of the next day or two, without getting a new high point, and that ends up being, then it's like we just got a second one touch. But, again, just one day off, but it's essentially the same thing. And if that ends up being the case, and we don't get new highs, and it just keeps pushing over until the green line gets back below 70, again, that's more bearish than not, right, than when you get these good runs. So, I mean, we are really rooting for a new high tomorrow, and this to really get going to the upside and breaking out here. Otherwise, that little touch up here, that kind of fake out breakout, producing what will eventually be the new 4-week high point tomorrow. And if we don't get close to touching that again, then that's not a good sign. And that's what I expect will happen, and I don't think that's a good sign. And again, another sign that we would fail at that bear tag that I showed you earlier on the market forecast chart. Looking at today's volume and trading range, you can see they were right about average, a little bit above average on the range, 5.69 versus 5.34, a little bit below average on the volume. Of course, the range and the volume are still kind of moving up slightly, but they're moving up. We're not quite to the 1.5% mark yet, where the ratio gets really big. We still haven't gotten 1.5%, the 1.5 times the average volume, which is another indication that we're washing out. Of course, we have on, we've been closer at least on IWM. We've had a few days over there of some big volume of red arrows. And of course, as you know, we haven't had the washout on the VIX yet. The VIX is still easily below 20. It's still well below 100%. The VVIX is still easily below 100. And the VIX itself is still, it's below 20. And it's, kind of flirting with getting below that 200-day moving average, even though the longer term averages are crossing, right? And so essentially telling us that we're potentially in a higher volatility regime here for a while. But as of right now, it's struggling to kind of gain some footing to the upside, and kind of like the banking crisis over here, which, again, during the banking crisis, we did get a little bit of a washout in volatility as it got up to the 200-day moving average, because we did get above 20, easily above 20, and we did get a lot closer to 100%. At least we spent some time intraday above 100%. Again, nowhere near that this go around. All right, now let's take a look at what's driving a lot of this price action here. So let's pull up the asset class comparison chart. And again, we know, really over the past 3 days, the last day before the weekend, where there was a lot of questions about what was going to happen over the weekend in terms of ground invasion, and volatility jumped up, the dollar jumped up, gold jumped up, bonds jumped up. I mean, it was like full on safety mode. To see, everything was up. Commodities were up, of course, because of the Middle East, but gold, bonds, the dollar, volatility, all up. Everything was up. Even though stocks were down a little, but not very much, considering how much these were up. Right, gold was up about, over 3.25%, or right around 3.25%. The gold did drop. Bonds really dropped. The dollar dropped yesterday, and stocks rallied, right? Everything kind of rallied up here, but gold kind of held. So you notice gold's actually still up about 3% for those 3 days. Commodities are still up about 2.5% for those 3 days. So there hasn't been a very significant change here, but bonds have really fallen off, which means yields have exploded to the upside. You'll see here in a second. And that's impacted the Qs, interestingly enough, more than anything. It has not impacted IWM, interestingly enough, which it has been impacted a lot more. Remember, IWM is in correction because of higher yields recently. And the higher yields that we saw today, which really took a jump to the upside, got up to 4.84%, the highest close. The 2-year yield is up to its highest close. I mean, that's a strong move. As you can see, the trend is still very, very strong on this index here. You can back above 40 on the positive, back below 20 on the negative. So very, very renewed strong move to the upside, and again, very little impact on the stock market this time, which is fascinating, especially on IWM, which has been impacted by far the most. Remember, the dollar also rallied on Friday. It's pulled back the last couple of days. It's losing its trend, but it's still on a bullish trend. It just hasn't, doesn't have the same momentum to the upside right now, as we are in a divergent mode here. And again, I don't know why it does this for this one index, the dollar index itself, but it's in convergence mode with the MACD down. Commodities, especially crude oil, is also another factor. It really jumped up on Friday. It bounced back up yesterday. It still stayed open lower, but moved higher today, back above the 17-day with the MACD rising above its moving average. So we've had a pretty decent pullback on crude, and it appears it's trying to get going on a new move back to the upside. The last 2 days being 2 days above the 17. That included that this one, the MACD was actually still below its moving average, and now we are above it. So move back above this 23%, and move back above the 30-day moving average gets us going on, continues to move us higher on crude oil, which has its impact on yields, and of course from there the impact on risk appetite in general. So you wonder again, we talked about this ratio, and we really had some good breadth here the past couple of days. As you can see, the new highs, still negative, but at least it's above its moving average there. You look at the McClellan oscillator, which was positive, not quite above 35 yet, but at least it was positive. Looking at the number of stocks above their 50-day moving average, you can see, it jumped up again, not by much, but at least it jumped up a little bit up to this 180 level. It's still above 150, well above its moving average. We're kind of faltering here, unfortunately. And of course, the 200-day still hasn't broken its moving average really yet. So that's still an issue. So there is some good breadth. It's not the best, but there is some good breadth there. And of course, the skew, it really took off over here on yesterday. It got up to 144 yesterday. So that's a big jump to the upside. And again, like we talked about, the skew hasn't pulled back enough for a typical, even just a typical pullback, much less a correction. Remember, the Russell is in correction and this is not. So I'm a little concerned about how big this move has been, how little we actually dropped, and how much the markets are still pricing in fat tail risk. Because again, as you can see, if I were to zoom out, being above 140 or almost at 145 as we were yesterday, you can see that's a high level. That is a very, very high level for the skew. It's not typical for it to be this strong, but it has been lately because we've been in a very mature bull market that has left a lot of investors concerned about big moves to the downside, which is what moves skew higher, is that demand because of big moves to the downside, not to the upside, but to the downside. The VIX being big moves to the downside in a short amount of time, right? Kind of your typical one standard deviation move, but in a short amount of time, whereas this is not your typical down move. This would be like more of a 2-3 standard deviation type move that the market's expecting. That's what they're protecting against when you buy the skew. So a bigger move, whereas the VIX is kind of your typical pullback type move. This would be more of a correction. When it gets this high, as you saw in 2021, it sets you up more for more of a correction than just an ordinary pullback. Let's take a look at how the sectors performed here today. So let me pull up the sector rotation chart here. There we go. And we'll take a look here at how they performed. Let's look at the last 3 days, and then we'll look at today. So remember, the last 3 days going into the weekend, and then the first 2 days coming out of the weekend, when risk appetite really fell, energy stocks did really well on Friday. The three-headed cyclicals areas like communication services, technology, consumer discretionary all lagged. And you can see technology is still lagging. Communication services is a little bit better as it's rallied up along with consumer discretionary. But look at energy is still strong, 4% rally. Staples is still very strong. Utilities is still strong. So, even though we've rallied the last couple of days, let me take off now Friday and just look at the last couple of days. You got communication services, but look at technology still lagging behind. Healthcare still lagging as it's been stronger. Staples is doing a much better job. Some of these other cyclical areas are doing okay. Not the strongest move. Look at that big drop in the morning on XLK before the rally, thanks to like NVIDIA, which is a big part of that, as well as Apple there. So, again, you can see the sector rotation, and again, looking at just today alone, you can see the moves today was materials and energy pushing up higher, technology, utilities, and real estate lagging, along with healthcare and everything else kind of showing really small moves, as the S&P 500 was ended up about as flat as it can be for the day. And that brings us to our trade idea of the day, and it's actually in this discretionary space. It has been really beaten up. Look at all those clusters that it's had on this particular intermediate cycle to the downside. But look at that bear tag it got yesterday, and the follow-through it's had today. It's up 8% above its moving average now. Strong follow-through. The market near-term line, momentum line, strongly bullish. The intermediate line still in bearish territory, but at least well out of the reversal zone now. The market sentiment line is so low. It's below the 5th percentile. It's extremely low. But it looks like we're starting kind of like a little bit of a move, like we saw over here when we were really bearish. We got a cluster, we got one cluster there, and then it turned higher. That appears to be the case now. You can see the weekly chart. Etsy's been in this death cross environment, but we got a green arrow finally. We had one over here, but we got a little bit better of a candle this go around. You can see that it is a relatively bigger size candle than what we've seen here on a negative basis. The PPO is starting to rise up higher. And here's kind of what stood out to me too. We got 3 green arrows on Etsy, and you had here. Let me pull up the this chart first, and let's pull up Etsy here, and you can see the 3 green arrows. You can see the above average volume on both of these days. You can see the stochastics getting they are close to that 80th percentile. Now we'll look at it here. So strong move higher on the stochastics. MACD is clearly above 0 now, as we are. Yesterday we closed above the 8, 17, and 30-day moving averages on the same day. Today we filled in a pretty decent sized gap between the 30 and the 50 in one day. And now you have a pretty decent sized gap to fill into the 200 here and get up towards that point of control again. So there's some pretty good potential to the upside. You look at the DMI here for Etsy. You can see we broke through above 25, below 20 on the DMI indicators. Looking at the RSI and the CCI, you are above 60 now on the RSI, well above 200. Again, it doesn't necessarily guarantee a breakout because we're still negative on the weekly, but those are both pretty good moves that we haven't seen for a while. Over here it took a lot of days to get above 60. Here we did it in two bullish days here. We went from 40 to 60. So strong move from that perspective. Looking at the Ichimoku cloud, obviously we're still below the cloud, but well above that blue line. We ended the bearish run yesterday. That was strongly bearish. And now again we're kind of starting the inklings of a bullish run here as we get a positive rate of change, which was the first time in a couple of months that we've had a positive 26-day rate of change. And then the Bollinger Bands, big breakout above the upper band, here, big breakout from a really low bandwidth too. So we were set up for a big squeeze play way inside the Keltner channels. In fact, we did close above the upper Keltner channel as well, the upper band and the upper Keltner channel, with the momentum now shifting to the upside through some red arrows. So what I decided to do is come over to the options chain for Etsy, come out to November expiration, look at buying or selling the 80, the low 20 delta. So this is the at the money. So not necessarily buying the at the money, but buying one strike out of the money and then selling out there to the 80. You can see from the Bollinger Bandwidth, you can move up to 83 with 1 standard deviation of a move. So that gives us a pretty good, you can see it's already a little bit more expensive than when I was looking at it. It's just moved up here today. And you notice it gives you, for a full position size, a good reward to risk for the trade. So really good opportunity. All we have to do is get above 80 and then stay there, which would be in this area here, and stay there for us to get that reward. And again, it looks like a good setup over the past couple of days, a good bullish breakout. And if it doesn't work out, again, we have very low risk because of this strong reward we're getting for that limited number of dollars that we're putting at risk there. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your week, everybody, and we'll see you all next time.